The dollar bull run continues with 4 consecutive weeks to the upside. But is this bull run sustainable, guys? Ken Chigbo back with another EA's market fundamental update. Let's jump straight into this. So, traders, as I say, the dollar is pulling back right now, and we have been running to the upside for 1, 2, 3, 4 weeks to the north. It is the best run that we've seen in a little while. I am somewhat pessimistic, and I'll get into the details as to why. But let's just quickly recap last week's data because we were very much focused on that US CPI, those figures, inflation figures in general. And as you look here at plain sight, people think inflation has cooled, it's those readings. But overall, when you look at the bigger picture and the key numbers, for example, the core, core, remember, strips out the volatility of food prices and energy prices. Core inflation is still sticky. When you look at the actual numbers, 0.2% higher than previous. When you look at the year on year, 2.8% in line with previous. And generally speaking, obviously the numbers there posted on Forex Factory, we, yes, we are slightly lower than the expectations, but in comparison to the previous, we're still higher. Okay. And the FOMC, remember, at the last press conference, they noted of inflation risks and they're not willing to budge. They're not willing to rush and cut rates until inflation comes down. They want to bring that down. The only way they bring that down is by keeping borrowing costs, interest rates higher so that spending should start to slow down, especially as we start to see slowdowns in the labor market. Obviously, Jerome Powell did warn at that press conference as well that we are going to see a softening in the labor market. We are seeing it. Unemployment rate will start to tick higher, less jobs be added to the economy. They need wages to go down to be deflationary. But right now, they're just not budging. You can see that data really reinforced that with the PPIs as well. Previous numbers revised higher as well. So there's still lingering sticky inflation. Retail sales numbers, as I expected, generally speaking, okay, bit of hit and miss there, but we're expecting them to slow down a little bit in comparison to the previous. And we have seen that, obviously, them slowing down. Yes, the previous were revised higher, but we are seeing consumer spending naturally slow down. We know consumer confidence is dropping. Look at consumer sentiment here, 50.8. So in terms of this data here, that just feeds into me, from what I've said to you guys before, this stagflation scenario in the United States where growth is low. We saw it with the last GDP number, remember, as well as a poor GDP reading. And we're seeing price of goods services remain high. So that's stagflation. So that's why I am pessimistic on this dollar pullback right now. And I think the narrative of US economic slowdown, the recession will pick up some pace again at some point. We just put it to the side for the time being. We parked it. But remember, we've got those raising of bets or raising of probabilities from like Goldman Sachs, JP Morgan, and other institutions. But when you look at this pullback right now for the dollar, for me, it's not convincing. Like these candlesticks here are just, the small bodies, they're not fully bullish. Like when you look in the past, we've had this bull run, look, big, bullish, convincing candlesticks in the past, convincing candlesticks, but these are still a little bit shaky. And, it's just going to go back to what I said before about technically the structure is still a little bit bearish. It's still been printing lower highs, lower lows. Like we really need to invalidate this and we need to go and clear this 102 area in order to see some upside. We need to see this. We need to go bam, bam, bam. Let's see how we deal with this because we could still face rejections there and we still ultimately go and respect structure somewhat, or we could fly. I am still leaning towards that upside being capped around this 102 area. Okay, I do believe that. Now, if we look at data this week, it's not a lot of data out of the US. Okay, so it's going to really be very much dependent on sort of general market sentiment. Okay, and then also potential, still going to have some headlines, potential developments of tariffs. Without a shadow of doubt, US and China, US and Japan, US and EU, all these talks are ongoing. Okay, and we'll continue to see developments from those hopefully this week as well, which will provide some volatility for dollar markets. But when you look at the PMIs, manufacturing expects to slip into contractionary territory. We know last reading was very close. Look, sitting just above that, just above growth territory. Remember, below 50 is contractionary territory. So previous reading was 50.2. This we're expected to slip into contraction, which depending on how deep that falls into contraction, markets are expected 49.9. Again, that'll feed into that stagflation narrative. Services expected to just be above growth territory at the moment, 50.7. We are cooling anyway, and obviously if that does cool further and slips into contraction, again, feeds into that stagflation scenario and that those slowdown fears around the United States economy. If you look at the Fed's watch tool, though, at the moment, markets you can see are pushing back on rate cut bets. June probability, obviously next to none, 8% probability that they're going to cut. July, 36.8% probability that they're going to cut. So you can see markets right now, I really believe sort of September, October, those cuts are going to start coming into play. But really, again, as Jerome Powell's reinforced, only if inflation comes down. So this week, when I look at the dollar, I still see some vulnerabilities. I think we could have some upside again, popping towards this 102. I want to see how the price deals with that area. With dollar related, such as euro, we'll take a look at that in a moment because we do have those key PMIs. But as I say, I can't look past further upside for the dollar unless we really convincingly start seeing some bullish candlesticks via the weekly, like really bullish, and we break down this 102 area. If we fail to break this down, I think we'll slip back into this bearish territory, this bearish structure, and continue to the downside. The euro. We do have key PMI data, manufacturing services PMIs across the Eurozone, and these have been on the mend. You know, remember before we are still in contractionary territory. Remember below 50 is contraction, but these numbers are creeping up. They're creeping up for Germany. They're creeping up for France. They're creeping up for the Eurozone as a whole, which is good. There have been a lot of calming concerns around the Eurozone. Remember, we had that stagflation fears as well with low growth and high inflation. But uh, things seem a bit more assuring for Euro for investors. Remember, we had all that money coming in for Euro because we had that stimulus from Germany. The ECB are very clear in terms of communication of what they're looking to do. There's no sort of it's clear. It's quite straightforward. They've just been consistently cutting by 25, being very, very gradual, of course. And I just think there's more investor confidence with the euro. So we're keeping these PMIs. I think obviously numbers are better, which we are in a trend of seeing better numbers at the moment. We're on the mend. I think that will further provide some support for the euro, but that's until Thursday. So that could tie in nicely with Dixie. Remember where we're seeing potentially a bit of upside in towards 102, but then some further downside could come if we fail to break that. With the euro here on the weekly, obviously, flip side to the Dixie, the trend is very much bearish right now via the weekly. I've got obviously price just being supported by this trend line. It's been in place since March. Obviously, we've been in an upward trend. We've come down to this trend line there last week, bounced off that, and ultimately we could be moving within this descending channel. This we could view it as a big bull flag, unless we break this, unless we break down this trend line here, okay, and we then see this. But otherwise, I'm still expecting this to hold. Okay, we could get a fake out, catch daily support here around 111 area, and then bounce and then resume to the upside. I'm leaning towards that because as we see with the vulnerabilities I see in the dollar, obviously I'm going to trade what we see. Either way, both opportunities, whether it breaks out, both scenarios, whether it breaks to the downside or to the upside, provide us an opportunity. So we're looking for a break retest of sort of 111.80, 112 for upside pressure in towards 114, even 116 and beyond. For downside, if we break this structure and break this trend line here and this key daily support around 111, we're going to see quite a fast drop in towards sort of 109.50 and then see how we deal there. Then we've got 108. But if you ask me my view, obviously it's not financial advice. I'm leaning towards this upside scenario for euro this week, as long as we get supportive PMI data. The Aussie dollar, we do have the RBA rate decision where these guys are expected, it's largely pricing that they're going to cut by 25 basis points, taking the base rate down to 3.85%. Now, that's largely priced in, as I say. I am expecting the RBA, this decision to cut, but it be a sort of a neutral to maybe even hawkish cut because inflation, yes, is falling back within their RBA's target ranges, which was between 2 to 3% on an annualized level. But that's at the upper end. There's still risks to the upside of inflation, like labor market. If we look here, so I want to show you data recently. Look at labor market. We're still seeing decent employment change, 89,000. Previous was revised higher. The unemployment rate remains steady at 4.1%. Wage price index is still elevated at 0.9%, which is inflationary, right? If we're getting decent wages, people spending money, and that's risking potential inflation spiking again. So yeah, I am leaning towards a hawkish cut, which should provide some strength for AUD. Obviously, pick your pairs wisely. There may be some other opportunities outside of Aussie dollar versus the dollar, but I'm just looking at Aussie versus dollar just as a base case for you guys. We'll also keep an eye on retail sales from China. Chinese data is important because remember, China's Australia's biggest two-way trading partner. So anything positive or negative has an impact on Aussie dollar. So we've got retail sales and industrial production data. If we take a look at Aussie dollar, if it fits with what I said, where we get that hawkish cut, we should see some upside. Obviously, on a weekly, we've had a pullback, but we've got a very key amount of demand around sort of 64.00, sort of 63.80 area you can see here, along this zone. On a daily, we're just in a lot of consolidation right now. It's not sexy price action by any means, but as long as this area holds, as long as this region holds here, we should bounce and continue to the upside and take a pop, a stab in towards 65.50. I said a couple of weeks ago before about so long as this uptrend continues, we can go and run into this trend line that we broke. Remember the structure where we're pushing to the upside, well, which helped not necessarily pushing to the upside, but we were supported there. Okay, because ultimately this was still part of a bearish trend. So we could come up for a big retest up there, up at around sort of 66, 50. 67s, but first sight on 65.50 is a very realistic target if we do get that hawkish rate cut from the RBA. GBP. We do have key data from the UK. Again, we've got PMIs and we've got CPI and retail sales. So it's a big week for the pound in terms of key economic data. When we quickly recap last week, data was good. When you look at average earnings remain elevated at 5.5%, previous revised higher to 5.7. The amount of people claiming unemployment benefits, 5.2K, which is good. UK GDP was higher than expected at 0.2%, better than expected, a bit lower than previous, but still better than expected. For me, all of this aligns with what I said. Remember with the Bank of England, where their last cut, yes, they cut, but it wasn't as dovish what the market's thinking. Bank of England members are concerned about inflation still. They're concerned about wages being high, wages pressure. And that just reinforced that, right? Wages still remain high, and it risks obviously inflation popping to the upside. If people are spending, getting paid more, they're going to be spending, risks of inflation going higher. So this data very much is still supportive of pound strength, which is why I remain a pound bull, generally speaking, across a number of peers. CPI is expected to spike up again, not surprised because of, the services inflation's higher, people are still spending money, consumers still spending money, people getting paid decent wage. So a number of 3.3% is going to be supportive of pound because it'll push back further on rate cut bets. As I said to you guys before, the Bank of England have cut, pause, cut, pause, cut, pause. And I think that sort of gradualist approach will remain the case. Keep an eye on manufacturing and services. So long as services remains above 50 or gets back above 50, that's going to be bullish for the pound. Manufacturing, obviously, the UK is not a massive manufacturer, but number expected to be decent there at 46.2. I mean, say decent, but better than previous. And retail sales expect to remain steady, and I'd expect that because obviously wages still higher and we're still seeing inflation pressures. I think spending still happening with consumers. The labour market in general is still buoyant, so I'd expect an okay retail sales number there, which would be supportive of the pound. Again, pick your pairs wisely, but I'm just going over GU. Obviously, GU at the moment is holding up better ground in comparison to like euro versus the dollar. It's holding up ground here. We've had that risk, that double top, but we're still holding. Okay, we're not giving up without a fight. This price action is very horrible. When you look on a day, it's pure range, right? On the 4 hours, quite interesting because we had a breakout of this flag here, this channel, but then we lost momentum. Okay, we can see if I'm just mark up near-term zone here, we've got a zone protecting sort of 32.50, nice and psychological. Further south, then we'd be looking all the way back down here at sort of mid 30, 32 to 31.50. I would still lean towards that. We break out of all this consolidation to the upside. Again, maybe a stretch, but we could view this as a nice big bull flag there or a wedge. Something's breaking out, this being a fake out here. So long as this area holds, like just anywhere from this range of 32.50 towards 31.50, this sort of just over 100 pip range. I'd be interested in this pushing to the upside and still going to running towards sort of 35.50, especially if that data supports it and inflation remains elevated, services PMI is good, retail is good. We're going to see the pound outperforming the dollar and pushing to the north. So I'm still leaning towards being a pound bull right now, so long as that data supports it. Last but not least, the Canadian dollar. Key CPI and retail sales numbers. I'm more focused on these CPI figures because I know markets are trying to ramp up their rate cut bets from the Bank of Canada to continue cutting rates because obviously they've been one of the most dovish central banks when you look at the major central banks. Inflation is expected to remain sticky here across the board. I would lean towards that we're going to start seeing a bit of a cooling in Canadian inflation. We know the economy is slowing down. Again, it's a sort of stagflation scenario. I know the economy is slowing down. If you look the week before last, we had the unemployment rate, the labour market worsening. This is the week before last. Unemployment rate jumped up to 6.9%, so higher than expected, higher than previous by quite a bit. So for me, I'd like to see inflation starting to come down. When you look at dollar CAD, we remain bullish, okay, at the moment, just given that dollar pullback. CAD could still be an underperformer when you look versus certain peers. I think like GP CAD as well is on my, not I think, GP CAD's on my watch list, further upside pressure. I like the idea of CAD underperformance, but we need to see that data to back that inflation coming down because markets then can ramp up their rate cut bets from the Bank of Canada, and obviously then we'd get CAD weakness. But right now on the weekly, it looks subject to taking another stab to the upside back into that 40 territory. Again, the consolidation going on right now. If we can break above this resistance here at 40, okay, then we're going to push into 41s, and then we can carry on pushing to the upside into sort of 42.50 and come back up to the upper part of this range. Obviously, if the data remains inflation remains elevated, we're going to come up to this area here. It'll fit with what I said with the dollar pullback initially. The dollar continued to the upside in towards 102. But then we could get rejections here and then carry on trending to the downside. Obviously, we have been trending to the downside. But this dollar CAD specifically is a bit of a trickier one to trade because I'm neither bullish CAD, neither bullish dollar, and I don't think markets are cautious. Markets are cautious on both of those economies as well. Okay, so pick your pairs wisely, as I keep saying, that's my quote right now. So once again, a week filled with economic events and talking points. We're blessed with some volatility. Again, I'm sure we are. Have an amazing and a blessed week, and I'll catch you on the next video.